Hello everyone and welcome to this week's video on Momentum Lab channel. So we have been talking a lot about DIY momentum investing, etc., selecting your stocks, ranking them based on momentum, etc., right? But what universe of stocks do you select from? So in the total Nifty market cap, we have around 750 stocks, right? So we have the large cap universe, we have the mid cap, we have small and micro cap. So which universe do you select in, and does it at all matter if you select from a particular universe? So let's see in this video if it matters which universe you select your stocks for your momentum investing from and how it matters to you and your overall portfolio. Without further ado, let's get into this video. So to understand what kind of universe suits our particular need and to also understand what kind of different parameters exist based on the different universes that are there in the NSE Nifty, we will be using a particular research study today. So we don't have to do all of this analysis by ourselves. We just have a very, very good study that has been conducted and published in the year 2023 by Rajan Raju. And this research paper actually talks about two important things. It's a two-component sort of a research understanding. The first part is selection of a particular universe, and it takes all of its evidence, data, etc., from the Indian scenario. And the other part of this study is to understand how many number of stocks is ideal for a particular portfolio holding. So the second part about the ideal number of stocks that we require that may be ideal for a portfolio holding will be discussed in a separate video. But for the purpose of this video, let's understand, what are the different universes that exist for us and how do we pick from a particular universe to then filter out our momentum stocks and then build a portfolio. So before I get into the details of the study, I would like to, tell you some basics that are very critical to understanding how this particular data has been taken and how the analysis have been conducted so that we are in a better position to understand the results, analysis, and therefore the entire idea of the universe size and selection for a momentum strategy. I'd also like to tell you here that this particular study or these particular results, etc., hold true only for the momentum kind of investing, momentum strategy investing, and not other kinds. So to begin with, for this particular study, Rajan Raju have used 12-month returns for calculation of the momentum ranking. So as you all know that when we build a momentum portfolio, we need to take the list of stocks. We generally take the list of stocks and rank all of these stocks based on the momentum or the, in other words, the returns that they have given. So we can have several look back periods. There can be 3 months, there can be 6 months, there can be 9 months, or there can be 12 months. So for this particular study, the look back period that has been considered was 12 months. So all the stocks have been taken, the 12-month returns of all of the stocks have been taken and momentum ranking has been given. So for the stocks with the best momentum, the ranking is obviously 1. And for the ones that performed the worst, the ranking is last. So what has been done for the purpose of this study is that the best momentum stocks, some of the best momentum stocks have been selected and invested in as a portfolio and have been rebalanced, right? And the rebalancing period for this particular study has been 1 month. Now, when we are also talking about data, looking back and, all of the points that have been considered here for the research, we must also know that this set of data that has been used for this particular video is extremely robust. So the data that has been considered is ranging somewhere from April of 2004 to April of 2023, which means that it spans around about 19-20 years, which is 2 decades. So how does it matter if the data is of 2 decades? Let me break it down to you. So in the market parlance, a 10-year or a decade sort of a timeline is looked at as a market cycle. So in this market cycle, we would have seen a bull run and we would have also seen a bear run, and the entire market cycle therefore is looked at for a decade's time period. So around 20 years would mean that 2 decades, or we could say that it is 2 market cycles. So such kind of a data is pretty decent in understanding, what has transpired for us. If you look at other markets, such as, let's say, the US market or the European market, we do have a lot more data available. That is, we have data from about 100 years or for about 100 years or 120 years. But when we come to the case of India, we can say that data for the last 2 decades or 20 years is also pretty decent. Another consideration before we go into the study is that no transaction costs have been considered while building, rebalancing these portfolios. And we must understand that brokerages and other costs that usually come when we as a DIY investor make our own portfolio have not been considered here. Now, another thing we need to establish clarity or base over before we proceed to the findings are how are the different stocks classified and what are the caps, right? So over here, you will be able to see that there are 4 different sort of classifications: the large, mid cap, small cap, and micro cap. So if we take the entire Nifty universe, it consists of 750 stocks. And when you consider the market cap of each of the stock and then rank all of these stocks from 1 to 750 according to their market caps, these can be divided further into these 4 categories. The first 100 stocks comprise of a large cap category. From the 101 to 250 comprises the mid cap. And then from the 251st to 500, we have small cap. And from the 500 to 750, that is the last 250 of the ranks, top ranks are comprising of micro cap. Having established these few parameters for the study, let us now get into the analysis and the findings of the study. So one thing I would also like to put forward here is that this particular study is pretty robust. It has been, it has a lot, very many details and nuances to it. However, for the sake of simplification of the study and to provide the larger audience with just some of the key findings, which are very important and which will help us make our decisions about the universe selection, the Momentum Lab team has simplified it, and we will be putting forward in this video only some of the key findings over here. Now, the first and foremost finding has been that when the market cap is smaller, right, as we keep going down the size, the momentum is bigger. So how does that translate to, and how can we understand this, right? So here is a particular chart that is depicting a composition if you have different universes. So if your momentum portfolio is comprised of different universes, what is the composition going to look like in terms of market caps? So this particular chart, if you see the first one, it is a momentum portfolio that is built on a Nifty 200 universe. In this case, what happens is over here, orange is depicted by mid cap and blue is depicted by large cap. So if you're constructing your momentum portfolio solely based on Nifty 200 universe, then you have almost an equal representation from both the caps. So large cap is around 50% and mid cap is around 50%. When you come to Nifty 500 universe, things start getting interesting over here. So over here, the green represents small cap, orange again represents mid cap, and blue represents large cap. So if your momentum portfolio consists largely of Nifty 500 universe, then the majority of your momentum-based stocks will be coming from the small cap universe. And a small minority will be coming from both the mid and large cap together. So if you may put it in numbers for simplification, the small cap stocks form a large majority of around 70% of the stocks that will form your momentum portfolio. Now, it gets even more interesting when we go to the 750 universe, where over here, red represents micro cap. If you remember, 500 to 750, micro cap. Green represents the small cap, orange mid cap, and again, blue large cap. So if you look at this, the micro and small cap are in fact forming the majority of the momentum portfolio that you will be picking. So it's about around 80% of it that comprises of micro cap and small cap stocks. So with all of this, what we are able to understand is that smaller the size of the market cap, bigger the momentum. And why does this happen? Because momentum rankings are based on the returns. And we have seen that smaller the cap, returns are larger. And hence, when you try to build a portfolio, momentum portfolio by selecting stocks from a 750 universe, you will be having a lot more, much more, or a majority representation from the small and micro cap stocks. So now that we have understood that the returns for these small micro caps are larger, which is why they are forming a major portion of a momentum portfolio, if you look at a 500 or the 750 universe, should I just directly then, or should one just directly consider only the returns for selection of their universe? Let's find out. So what the study says is that it is, there are other parameters which one, or which an investor needs to consider when they select a particular universe. And I think it is also going to be prudent here for me to reiterate the fact that choice of the universe based either on, whatever different parameters or just returns is solely on the discretion of the investor. So, for example, if I am a conservative investor, I will have different parameters to look at. And if I am a risk-taking investor, I will also have different parameters to look at, right? So that will largely differ between the kinds of investors, and that will also largely dictate the kind of universe that you will be picking up stocks for your momentum-based portfolio. Now, coming to the parameters which are important, the first parameter, of course, is returns. There is no investment where we will not be looking at the returns to make a decision for. So returns will form the first parameter when we look at which universe we have to choose. The second, obviously, that follows the return parameter is the risk parameter, right? So if we are putting in our money and we are looking to make investment and returns out of it, we will also be looking at how much risk will I be encountering when I put in my money in a particular portfolio. And it goes the same for this as well. So let's just consider that, there is around 100 rupees of investment that you're making, and the returns are about 20%. So you will be making the probability that you have is that you can make around 120 rupees if you put 100 rupees. And let's assume that the risk is 10%, which means that you may encounter a loss of 10 rupees. So overall, over here, your returns are 20, but your risk or the possibility for loss is 10. So in this scenario, if we look at reward to risk ratios, our rewards are looking slightly better. But consider the situation where we are going to put 100 rupees and our rewards are still the 20 rupees, but our risk can be 40. Right? So our portfolio can either become 120 rupees or it can also fall down to 60, which is 100 minus 40. In that scenario, the risk we are taking for the kinds of returns we are getting is not favorable. It is pretty skewed in terms of the risk. So naturally, risk matters when we are looking at trying to choose for a universe for our portfolio. Now, the third parameter is drawdown. Drawdown is nothing but a maximum fall that one portfolio can, or a particular universe can undergo. So we all agree and we all know that markets don't move linearly, and neither do stocks. There is correction happening all the time. There is fluctuation happening on a minute-to-minute basis. And sometimes there are also possibilities for huge drawdowns or market falls. So the maximum drawdown is also something we need to consider when we are choosing our universe. And the fourth criteria is, or the parameter is, the number of days that it will take for you to recover from the drawdown. So yes, you have undergone a drawdown. Market falls, as we have spoken, are bound to happen. So what happens after market fall? How long will it take for your portfolio to go back to that zero value where you have started? This number of days also forms a very critical aspect when you're considering the universe for your portfolio. So let's go into the study further and understand what the data is showing us. So for the sake of this study, 6 different universes have been considered: the Nifty 200, 325, 500, 625, 750, and mid small cap 400. These universes again have been arrived with all of the market cap being laid out and then them being sorted from the highest market cap to the lowest. The top 200 of them, which is 100 large cap and some of the mid cap, form the Nifty 200 universe, and the large cap and mid cap and some of the small cap form 325 universe. The large cap, mid cap, and all of the small cap form 500 universe. the 625 universe comprises of all the above and some of the small cap, micro cap stocks, and Nifty 750, which is the total index or the total market index, comprises of all the stocks that are listed in NSE universe. And mid small cap is a category which comprises of two different caps and has 400 of them, which is just the mid cap and the small cap. I will discuss this at the end after discussing all the first 5 universes. Now, another consideration that we have to understand at this moment to clearly understand the different parameters of return, risk, drawdown, and drawdown days is that several different portfolios have been constructed. So 16 different portfolios have been constructed with different stock sizes. So a portfolio has been taken with 5 stocks, 15 stocks, 20 stocks. So the range of these 16 portfolios are somewhere from 5 to 80. So this data is an average data for all these 16 portfolios across these 6 universes. So let's get into the results and findings right now. The first one is about the mean annual return. Like I said, across all of the portfolios constructed, and for the last 20 years or 19 years, the 2-decadal data, the Nifty 200 universe for a momentum portfolio gives you a return of about 24.52. So in some senses, if we juxtapose this with the returns of Nifty itself, the returns of Nifty somewhere lie around 14 to 15%. So a 24.52% return, mean annual return for a momentum portfolio in this category is in fact a very, very decent return, a very good return, if I may say so. Now, going to the next universe of 325, we can see that the returns have considerably increased, with 27.37 being the mean average annual return. And when you go to 500, the returns even more increase. They take off even more with a 33.49%. When we come to 625, it's at 33.51, and for 750, it's at 35.12. So what we are understanding is that as and when we climb from the 200 universe to including the mid, micro, and small caps, our returns are drastically increasing. But let me tell you one thing, that the jump that we are seeing from 200 to 325 and from 325 to 500 is not exactly the kind of jump we are seeing when we include many more micro cap stocks and all of the micro cap stocks. So this is where we see a lot of jump in terms of returns. Annual standard deviation. Standard deviation is something tells you how far away or what is the exact range of the returns that you can expect when you construct a portfolio or with a portfolio that you construct. So for the Nifty 200 index, the standard deviation is at 25.84. So what this means is that your returns can range anywhere between 0 to 50. We arrive at this number simply by understanding the return 24.52 plus or minus the standard deviation 25.84. So we need our standard deviations to be lower so that it gives us enough meat to see if our rewards to risk ratio is favorable for us, and if we are getting enough reward with the risk that we are taking. In fact, if you remember, we had discussed Sharpe ratios as one of the key indicators or parameters which can easily give us an understanding of this range of returns. And we have also established the fact that a Sharpe ratio equal to 1 or greater than 1 is a desirable Sharpe ratio. Now, and in point 3, we also have Sharpe ratios calculated, where for the Nifty 200 index, we have 0.71, which is not very close to 1. And then as we move across the caps, we are reaching 0.91 at 750. We have 0.88 at 625 universe, 0.90 at 500 universe, and 0.75 at the 325 universe. So what this tells us simply is that the Nifty 200 universe, which we may choose as our universe to construct our momentum portfolio, does not have a lot of favorable reward to risk ratio. And as we go up, a Nifty 750 universe gives you a very good or closer to 1 reward to risk ratio. These are not the only 2 parameters that we will be looking at. We will be looking at key parameters like drawdown days and the max drawdowns, as we have established that the amount of loss which we are willing to take or which we are willing to endure and for how long we are willing to endure also forms a major part of the kind of investor we are and the kind of investments we are willing to take. So with respect to max drawdown, we have Nifty 200 universe at 28.5%, which is the lowest when we consider all other universes. So when we come to the Nifty 750 universe, our drawdowns can range to as low or as deep as 45%, which is almost 50% of your investment value washed out. We also have at 325 universe 30.6, at 500 33.5, and at 625 40.5. So significantly lesser kind of drawdowns, max drawdowns, are visible at the Nifty 200 universe. And when we next look at the number of drawdown days or the number of days it takes to recover from such kind of a downfall, the Nifty 200 universe has the least number of days. So around within a year's time, which is 214 days, we are able to recover this max drawdown of 28.5. The further we go down the caps, the larger these number of days have become. In fact, the jump from 200 to 325 universe over here is really high, with 325 universe taking around 700 days, is almost 2 years, and the 500 universe also having similar number of days. With 625, it's larger, around 853 days, and for the 750 universe, it's almost 3 years. So what happens in such a scenario is that, when you have a 50% drawdown or almost 50% drawdown, and it taking 3 full years for your portfolio to come back to the zero, not every investor is willing to put up with this kind of a drawdown or these many number of days. So if you are a risky investor and you don't have to draw money from the market for any of your personal uses, you may feel that, 3 years is not a long time. I can wait it out in the market, considering that the returns for this category are really large. But if you are a conservative investor and want to have smaller drawdowns and even smaller time periods for the recovery, you might compromise on your mean annual returns or the returns and say, listen, around 25% return for me is fine if I have to look at just a 29% drawdown with 200 days, with less than a year sort of a drawdown. Considering these parameters, what the study does is it also categorizes a new mid-small cap category, which comprises of 400 stocks, 150 mid-cap and 250 small cap stocks. Now look at how this particular category functions. The results are extremely interesting. Now this mid-small cap category has a mean annual return of 34.737, which is way ahead of 24.52 or even 27.37. It's even greater than what the Nifty 500 universe has to offer to us. In fact, it is not very, very far away from what the 750 universe gives us. And if you look at the Sharpe ratio or the standard deviation reward to risk ratio, it's at 0.93, which is even better than the 750 universe. It's quite close to 1, therefore making it the most favorable return to risk ratio. Let's come down to the drawdown percentage, max drawdown percentage. And we see that even this value is pretty close to the one of Nifty 200 index, somewhere in between 200 and 325, which is at 29.4. However, the only parameter which is, slightly thought-provoking for us or for investors is the number of days that it takes to recover, or the number of drawdown days, which is at 670. So while it is lesser than all other universes except for Nifty 200, it is still nowhere close to what the Nifty 200 offers. If we just put a blind eye on the number of drawdown days, the mid-small cap 400 universe might just be the best universe to consider. Again, this is not according to me. This is according to the study. Everything that I'm sharing here with you is a direct analysis and a direct putting forward the findings that have been given by the research paper. It's not my take, and it is what the paper recommends. So the Nifty mid-small cap 400 universe does give tremendous returns with good risk to reward ratios and minimized drawdowns. However, with the number of drawdown days or the recovery days being quite large. Now, again, at this point, you can pause or take a screenshot of this particular table, or I will link the paper here in the description for you to go and peruse at leisure. So you can see what are the kinds of different returns, risks, risk to reward ratios, drawdowns, and recovery days. And you can take a call about what kind of an investor you are, how much and how long are you willing to put in the market, and how much of a loss you are willing to put, and take a call about the universe that is good for you. So there is no one answer, there is no one correct answer. Investment is a very personal choice and it depends on a lot of parameters. And even over here, all of these indicators are just going to give us those parameters with which we can decide what stocks our momentum portfolio should come from or what universe it has to come from. In the next video, I will be discussing what is the ideal number of stocks to hold in a portfolio and what should your ideal portfolio look like. Thank you so much for joining me in this video and see you soon.